Hey, it's Jim, and this is the topic on alternative investments for portfolio management and the reading on hedge fund strategies. Those of you who looked at the reading will note that this is a super long reading, so what we've done is divide this into part 1 and part 2. What we'll do in part 1 here over the next, this is going to be a long one. We've got about a 60 slide deck. It'd probably take me 60 minutes to get through this. But what we'll do are those first 4 LOSs. And I'm going to ask you to do me a favor. I've never done this in any recording that I've made, level 1, level 2, or level 3. But as I was going through the reading, I was trying to decide what's the best way for candidates to wrap their arms around this massive amount of material. So what I want you to do right now is I want you to pause the video and I want you to go get 6 index cards. And at the top of each of those index cards, I want you to write those words: equity related, event driven, relative value. We'll do that now in part 1. Then opportunistic, specialist, and multi-manager hedge fund strategies. Write those words across the top of each of those 6 index cards. And then down the left-hand column, I want you to write characteristics, strategy implementation, and role in a portfolio. And I want you to do this, A, as I said earlier, to kind of wrap your brain around this massive amount of information. But 2, and perhaps even more important, if you look at the questions at the end of this reading, many of them have a question stem, and the answers are 3 of these potential hedge fund strategies. The remaining questions will focus on one of these strategies, like event-driven, and then they'll ask questions: what are the characteristics? What are the strategies? What are the roles? So if you have these 6 index cards, and you can probably arrange them in a nice rectangle on your kitchen table, take a picture of it, and then you'll have that to study going forward. Now, what we typically do with these really long readings is go ahead and give you guys just a brief recap. We did this back in level 1, level 2. Look on the left-hand side. You know about traditional investments. You know about alternative investments. And so our focus here is on hedge funds. Look at the very bottom. Crucial subcategory of alternative investments. Of course, there are pros and cons. So let's take a look just quickly at some of these features. There is, government influence on the behavior of hedge funds, but there's also regulatory bodies. So in general, hedge funds are subject to fewer constraints. They probably have way more flexible mandates than regular old mutual funds. And look at that second bullet point there under the green. And, let me go back here real quick. So you have this traditional investment universe that might look like this. You add the alternative investments, it goes like this. But the fact that you can add derivative securities, boy, it makes it super massive. So there's the investment universe I just said about that. There's the investment style and leverage. It's probably important, and I'm guessing you remember this, that lots of leverage in hedge funds and less liquidity. So let's go back here. More leverage, less liquidity, especially with limited partnerships. You have this lockup period that might say something like, send us your money today. You can have access to it in 3 years or 5 years or 20 years. I mean, that's really the ideal. The ideal hedge fund manager would say something like, send me your money today. You can have access to it in 50 years. And then you don't really have to worry about it as the hedge fund manager. Of course, not too many people would probably be willing to give up their money for that time period. The cost structure, we did this back in level 2, where we actually computed the total cost with that assets under management, maybe 1 or 2%, and then some kind of a performance fee, 10%, 15%, or 20%. If I remember correctly, we went through in level 2 with an example of a 20% performance fee. So look at the bottom here. I say this to you regularly, right? Marginal costs, marginal benefits. There's lots of good stuff associated with hedge funds, but then there are costs associated with it. So, really, do you get extra returns? What does it do to diversification? Do you have to pay the extra fees? I mean, are they implicit? Are they explicit? And so sometimes it's difficult to answer that question. When you calculate marginal cost and marginal benefit of buying a $5 Honeycrisp apple at the food store, you can make that decision fairly quickly. Here it's not quite as straightforward. So we have high fees, we have added cost, complex documentation, limited redemption, lack of transparency. And so the idea behind these hedge funds is that you've got all this stuff going on, and is it worth it? Well, sometimes it is, sometimes it's not. But what we know is that hedge funds can offer what's known as this illiquidity premium, because what we see is that these liquid alternatives that offer those things in the gray boxes, they perform worse than hedge funds. And so it's probably good to remember there's some lack of liquidity premium inside of hedge funds. All right, so let's go ahead and attack this very first LOS. Well, these are the headings on top of your 6 index cards. Now notice there are some really good, interesting items in each of the rectangular boxes. I'm not going to cover those right now because we're going to cover them in super detail here in part 1, and then we'll do these 3 in part 2. So here's the summary of what your 6 index cards should look like. Now, look under equity, which we're going to spend, I think it's 12 or 14 slides. We got to worry about 3 types of equity hedge funds. So you might have to turn your index card over, which will offer you some kind of a challenge if you're trying to take a picture of the front and the back. So there's a summary of what your index cards ought to look like. So let's go ahead and start with, kind of a general sense of these equity related strategies. Of course, we're going to invest mainly in stocks. Notice we have that second arrow point there, skillful stock picking. So this goes back to the very beginning of level 1 and the historical context of the CFA program, this mosaic theory that we've got all this training, we have all of this knowledge base, we have all of this experience, so that we're going to be able to navigate the weather patterns inside of the floor of the New York Stock Exchange, maybe better than others. So equity risk. So what does this mean? It means market risk. It means systematic risk. It means economic risk. You've heard me say this before. Look, when you invest in a portfolio of equity securities, whether it's a well-diversified portfolio or a concentrated portfolio, you're essentially betting on the economy to expand. Now, if you own a well-diversified portfolio, you're betting that the economy as a whole expands. If you're investing in a concentrated portfolio, let's say we're concentrated on banks that specialize in managing the assets and liabilities for startup and tech companies. Does that sound familiar at all in 2023? So that concentrated risk, you're betting that particular sector or that particular industry expands. But it's still called equity risk. So here's some subcategories: long short, which we'll talk about, dedicated short bias, and then market neutral. Look at that bottom arrow point. That's probably a really, really good exam question. The portfolio's beta is going to determine that particular classification. All right, so let's do this long short equity. Counts for 30% of all hedge funds. So what do? We go back to the capital market line, we go back to the security market line. And however we're going to do this, top down, bottom up, all the stuff that we've learned inside of the CFA program, we're going to identify a handful of securities that are undervalued, a handful of securities that are overvalued. Now, of course, most investors take long positions. And so we're probably going to be, a little bit biased towards the long position because, I'm not sure if I even want to say this, but it's probably generally easier to find undervalued stocks than overvalued stocks, mostly because of maybe some behavioral issues, maybe some herd mentality, maybe just the way we're trained. We look to find stocks that we think can increase in value over time because of just what I was saying here. If the economy expands, the rising tide lifts all of the boats. But our challenge then is to find those securities that have a potential for greater capital gain. I think you know what I'm trying to say there. Now, on the opposite end of that, if we find overvalued securities, then we can take the short position there. Stock picking and market timing. So that should make perfect sense. So here we go. Investment characteristics, net long 40 to 60%, return profile. Here we go. Total returns are about the same as long only, but the standard deviations are lower. Man, that sounds like a super exciting exam question. One that if I were a test creator, I would go ahead and say, what are we doing here if we're just giving ourselves the same type of returns? Well, the second moment of the distribution tells us, hey, we can do it at a lower standard deviation, because what we're doing is essentially we're betting against ourselves, right? We have all these long positions and then we have some short positions. Now, if we have 60 long positions and 40 short positions, wouldn't it be awesome if all 60 of those positions increased in value and all 40 of those short positions decreased in value? We would be 100% right. What kind of a information coefficient and all that stuff that we did back in level 2? What would that mean for us? Yeah. All right. So remember, standard deviations are lower. Suitable users, these are limited partnerships. Of course, we said that just a moment ago about hedge funds. Attractiveness, liquidity, and diversification, able to reduce the beta risk, because every time you short a share of stock, you're adding a negative beta. So if you have a bunch of long positions that have betas of 1.2 and 1.3 and 1.7, and then you short a share of stock that has a 0.8 beta, well, that would be a minus beta. And so you just do a weighted average there, reduce beta risk. That should make perfect sense. Now, leverage in this long short really depends on the approach that is used. And we'll see that, especially when we go into market neutral. So swing back to that as we move through this slide deck. All right, watch this. Let me go through the slide. So we have a specialist and then we have a generalist. So you can imagine what these two individual hedge fund managers look like. A specialist, so we're concentrating on specific industries or specific sectors. Hey, there are two words that I just used, top down or bottom up. Pick your sector, whatever it is, and then what you do is you find overvalued and undervalued stocks inside of that sector. Now, of course, as the good financial analysts, we probably want to have some background in that sector, right? If I'm going into biotechnology sector, it might help me if I have an undergraduate degree in biology. My undergraduate degree is accounting, and so I probably could do okay as a specialist in the biotechnology sector, but I probably wouldn't be a superstar, because what the heck do I know about biology? I can read about it, but we need to have backgrounds like this. That should make perfect sense. Disadvantages, fewer funds. There's not a ton of them over there. And they might be difficult to analyze and access these hedge funds for a variety of reasons. Now, the generalist then goes something like this. Let's go ahead and not worry about concentration. Let's go ahead and pick multiple industry groups. Avoid complex sectors, crucial, intricate details, right? May struggle to build an edge. So just think about, the specialist probably much better trained inside of each of these areas. The generalist, kind of has a macro exposure and a macro background to, not just the economy, but to whatever those individual securities are that look inside of that portfolio. All right, we did mention earlier flexibility, we mentioned diversification, and we mentioned hedge. Yeah, there's high fees and added alpha that we talked about. So let's go ahead and look through a potential good exam question here. Here we have CIO, Sarah, great importance on long-short equity investing, working with managers who mastery in both long and short. All right, due to financial limitations, she's not inclined to pay high hedge fund fees for long biased beta. All right. market. She can access similar returns at more affordable prices. She is willing to pay hedge fund fees for strategy. So what's the most likely hedge fund strategy that she should consider? And then let's talk about the advantages and disadvantages. All right, so this is probably going to be some kind of a sector specialization, specialized knowledge, right? That makes a lot of sense there. Potential problems, harder to evaluate, maybe fewer options, and that attractiveness may deteriorate over time, mostly because, sector performance, it switches. You got a high performer here and a low performer here, and then they switch. All right, how about this second part? Dedicated short selling, and then short bias. So dedicated short selling. This is short positions only. Short bias. Well, they're biased. What did we go back to that long short? What did we say in one of those slides? It was 40 to 60%, maybe up to 80% long positions. Well, the short bias would just be the reverse of this. Yeah, so what are we looking out for? How do we find these overvalued stocks? Weak and unsustainable business models. Am I allowed to say this right now? Look at SVB in the early spring of 2023. Deceitful accounting, mismanaged companies, radical shifts in public perception. So those, red, green, purple, and blue, those are kind of easy things for the Institute to say. Yeah, look out for deceitful accounting. But, oh my gosh, how in the heck do you know that it's deceitful? Well, we're going to talk about a couple of ways to do that here in just a few minutes. But have you guys read about what's that chain called? Buffalo Wild Wings is being sued because their boneless chicken wings are just regular old chicken nuggets. How do we know? Is that deceitful accounting? Is it deceitful advertising? Whatever it is, I don't know. It doesn't sound right to me. It doesn't sit well with me, as Kramer on Seinfeld might say. But it's a lot more difficult to uncover deceitful accounting. I'm going to tell you a story here in just a few minutes. All right, here we go. Some more things for you to write on your index card. Investment characteristics. All right, so there we go. 60 to 120% short at all times. Primarily focused on single stock picking. So what does that mean about short biased managers? Is that they probably have lots and lots of unsystematic risk inside of their portfolio. Lower return targets as opposed to other hedge fund strategies. Negative correlation benefit. We talked about that before. More volatile, short beta exposure. Yeah, that makes sense. Limited partnerships. We said that before. They provide liquidity. Negatively correlated alpha. Yeah, leverage. Leverage in this case is probably a little bit low. Adequate natural volatility. So what you're going to do now on your index cards is probably pause my recording and just pick a couple of things for you to write, some bullet points that you think are important as we go through this. Now I'm trying to emphasize some of them, but of course I can't emphasize all of them, and something might sink in with you that doesn't sink in with me or sinks in differently with other people. But try to pick bullet points that are going to prompt you to think about other things as you go through this. Yeah. All right, how about the strategy implementation? Short sellers, identify securities that will fall in value. Mostly accomplished through a bottom-up approach. I mean, this ought to make sense. We start with the general economy. We want to start with individual companies, so we're going to do this. And here's what I was telling you about earlier. I'm going to tell you a story. So there's the Altman Z-score, which is a measure to determine whether companies are on solid leveraged footing, or are they in financial distress, or are they headed for bankruptcy. So you can use that Altman Z-score. But then down at the bottom in the purple, this Beneish M-score, this is really, really cool thing. This model uses 8 variables that you can get from the financial statements. So you could do this right now. In fact, you could do a search as you're listening to me, type this Beneish model in and type in Excel, and you can download a free Excel model, and you can just type in these accounts from the financial statements. Now, this was developed, I want to say sometime in the 1990. But several students at one of the top line schools in the country, as a project, they did this on Enron, like 1997, 1998, whatever. And they came up with a score that said something like, hey, Enron, there's something going on here. And they published this, and I think there were articles written about it. It might even have shown up in the financial press. And of course, we all ignored it, right? And so 2 years later, when did Enron crash? 2000, 2001, whenever that was. But this M-score is really a cool model. Now, the LOS really doesn't tell us to dive into that. I wish that it did. I wish we could go through and look at all these 8 categories and you would see how cool it is. But I'm guessing the LOS would just say something like, how do we want to implement this strategy? Well, let's look at the Z-score and let's look at the M-score. That's probably the limit of the questions on the exam. So remember, a Z-score bankruptcy, the M-score manipulation of financial statements. And by the way, I think the rule of thumb is that if the M-score is less than a minus 1.78, then we're perfectly fine. So Procter & Gamble and Johnson & Johnson, they would probably have an M-score of a -2, but I think Enron had a score of like a +2 or something like that. Here's just a quick slide here. Common tools we can use to identify securities. Remember, this is the bottom up. Let's go ahead and look at credit default swaps. What my students do in my investments and derivatives class is they go and take a look at the Moody's rating. And then they get on Bloomberg and they go and look at the price of the credit default swap. And they try to compare the two and link the two. And then they do some research on these individual companies, and most times they come up with an ID that says something like, this company is probably okay. But we have a student managed fund with our kids that are finance majors, and the board does not allow them to short shares of stock. And I keep telling them, you got to go to the board and let them and convince them to let you buy put options and shorting. So anyway, credit default swaps, that's a great source because it's a market price. And then, of course, those of you who know Bloomberg will know that when you go inside of that credit default swap function, that you can get things like, yield spreads, yields, volatility. You can get all sorts of stuff inside of the credit default swap market and then outside of it in just regular bond issues. So what's this role? Negative correlation, significant advantages, right? There's extra costs. And look at that bottom bullet point there. Past performance has been inconsistent and generally underwhelming. That's why we have a little frowny face dude over there on the right. So what is this telling us here? There is a role, but what we find out in both academic and professional research is that the superior equity-related hedge fund manager probably is unable to maintain that superiority and persistence in earning in performance domination over longer time periods. This is true in mutual funds as well. So it's not surprising that, oh my gosh, are you ready for this? Reversion to the mean. Reversion to the mean. That's really a cool concept. All right, how about this last one here? Equity market neutral. All right, so this is still your first index card. What are we doing here? Equity market neutral. Well, what we're doing here is we're probably going to take a bunch of long positions and we're going to take a bunch of short positions and they're going to offset each other. Now, remember some of the examples that we did in derivatives back in level 2, and I showed you an example where you could come up with what's called a perfect hedge, where you would lock in to the future selling price or buying price of gold or oil. Well, in equity market neutral hedge fund strategies, we're not trying to exactly offset, right? Because we want our long positions to increase in value. We want our short positions to decrease in value. But a lot of times they're going to offset each other and we'll end up with a beta of 0. So that's the key part of this equity market neutral. So how can we do this? Well, look on the left box over there. There's the beta that I was talking about. We can also use the delta from the Black-Scholes-Merton option pricing model. Remember, that's that cumulative normal probability density function. That's a really cool thing. And it can easily be shown that you can use that delta to form a risk-free portfolio. Now, I'm not suggesting that these equity market neutral hedge funds are looking to find a risk-free portfolio, but how about if I just say maybe a nearly risk-free portfolio at certain times? And then you can transform that delta into a dollar delta. You can use size, PE ratio. You can use book to market ratio. There are a bunch of other things that you can look, but go down to the bottom, the arrow pointing down. Minimize portfolio beta exposure. So just remember this beta is going to be somewhere around 0, but yet we can generate alpha. So do you see the similarities back to what we were talking about earlier with the long short, right? We're not going to go ahead and maximize our systematic risk or our market risk, but we're still searching for alpha. All right, look at the bottom there. Quantitative methods, this makes sense. Security selection, market timing. Yeah, these are all things that we're learning inside of the CFA program. So what are these types of equity market neutral? Quantitative trading, multi-class trading, stub trading, pairs trading. This is what I have my students do regularly in class. We'll take two similar securities, and what I have my students do is calculate a correlation coefficient. The classic example is either like, Walmart and Target or Coke and Pepsi. You take these two stocks, you calculate their correlation coefficient, and it's probably 0.85 or something like that, right? High correlation. However, their prices have moved away from each other for some reason. Some other reason, so reversion to the mean, or what we're going to do is expect that those correlations would then kind of converge. I'm not sure if that's the right word, but it sounds like it's the right word. And so what do? We take the short position and we take the long position in these two pairs trading, right? So that they are relatively mispriced. So they'll probably leak back to their historical averages. Boy, look at that bottom bullet point, mean reversion. Boy, that's just some of the coolest parts of the study of finance, that there's this concept of mean reversion. Who would have thought that? Of course, what we can do is say something like, all right, here we have a parent company. Maybe we really like that parent company, but it has a stinky subsidiary. So we can go long in the parent and short in the subsidiary, or we can do just the opposite. That's called stub trading. Multi-class trading, this is taking a look at the difference between voting shares and non-voting shares. And you could probably extend this to preferred shares, maybe some other type of voting, like, there are some companies allow cumulative voting. There are different ways to kind of chop these different classes of equity shares. And so you just take long positions in one and short positions in the other. And then, of course, you can use some kind of quantitative model. And what this will do as the result, of some, high level stuff. And some of the inputs in this high level stuff might be price changes, but they might be some kind of fundamental factors. In this quantitative model, you can throw kind of anything in there. Remember, we're trying to find undervalued and overvalued stocks. All right, so here we go. Investment characteristics of these equity market neutral. Relatively low risk, that should make perfect sense. Exposed to leverage, right? We got lots of short positions, so we have margins there. And tail risk, oh my gosh, particularly during periods of market stress. Remember our conversations on value at risk and expected exposure. We're worried about that left tail of the distribution, so that's what we need to worry about here. Return profile, modest return, but there's a lower standard deviation, probably shorter time horizon, high leverage, right? And, high liquidity. The reading says high liquidity. I might say moderate to high liquidity. Diversification. Probably not the diversification that Harry Markowitz or William Sharpe had in mind when they were investing in the efficient portfolio, but it's still high levels of diversification. There's limited partnership. That's been true for all of these here. And then attractiveness, profit from short-term mispricing. Notice we put that in bold down there in the bottom right. So that's probably a good exam question. How do we implement this strategy? identify tradable stocks. So that's bottom up. We can use any of these quantitative models, so fundamental, statistical models, factor models, any kind of a model. Constraints, yeah, the biggest constraint here is on, well, let's just take beta for an example. We might say something like, you know what, we want to have a maximum beta of 0.5. Leverage in all of these equity-related hedge fund strategies, we could have tons of leverage. Now, some of them, lend us to less and less leverage, as was noted in some previous slides. But of course, we want to link, whatever loans that we take out, whether it's, from a margin or using margins or a derivative or whatever it is, we need to make sure that it fits in conjunction with the policy statement. All right, deep breath there. So we finished 1/3 of this part one. So let's go to event driven, and we could have tons and tons of different corporate events, but the reading focuses on two: mergers and distressed securities. So distressed securities swing back to that Altman Z-score. Now here's a list of in this illustration of different events that might lead securities to be mispriced. So the focus again, mergers, bankruptcies, but share issuances, share repurchases, capital restructuring, accounting changes. So that goes back to the M-score there. You see how all this is linked? And the CFA program really is linked. When you first start on this program, you think, oh my gosh, this stuff, it's almost like chaos theory. But now that where are we now? We're in the middle, at least the middle towards the end of level 3. You ought to be saying to yourself, you know what, that institute, those people really know what they're talking about. All right, how do we do this? Soft catalyst, event-driven approach. That means that we're going to make an investment before an announcement. What we're trying to do is predict the future. Hard catalyst, this is an investment made after the event is announced. But notice that second bullet point here. And boy, I always struggle with this. I just struggle with reading this, but I'm going to go ahead and read it to you. Take advantage of the security prices that have not yet fully converged. Remember, I was in graduate school and our professors, they hounded us and they said efficient markets hypothesis, Eugene Fama, stock prices reflect all relevant and publicly available and material information. And so I always struggle to read that not yet fully reflective or convergence of all of that information. But over the years, I have agreed that there are pockets of inefficiency out there that persist. And so that's what we're doing there inside of that green. So the main risk is event risk, because sometimes a merger just goes away. How many times do you read in the Wall Street Journal where two companies, they say, you know what, we're deciding to get married. And these two companies, they say, we're going to merge. And then they say, you know what, we don't like each other anymore. We're not going to do that. Now, most of the time, the decision that we don't like each other anymore doesn't come from the two individuals. It usually comes from the government. And the government steps in and says, you know what, there's a monopoly threat in there. We're not going to let that occur. All right, so how about we look at merger arbitrage? And I want to make a comment here. I'm going to editorialize about this word arbitrage. Remember, from our very first days back in level 1, I explained to you that arbitrage requires no investment. It has a positive expected return and incurs no risk. That's the definition. That's the classic definition of arbitrage. However, professionals and academics out there have liberalized, I'm not sure if that's the right word, the definition of arbitrage to include things like, hey, if things materialize the way that we think they are, then we're going to make a bunch of money. All right. So there's still some risk and there might be some investment, but there's a positive expected return. So I don't want you to think merger arbitrage is risk-free. That was my whole point of that little editorialization. All right, here's a little flow chart. So there's the deal. The manager invests in the merger and acquisition, and if it's successful, the manager earns the spread between the target company price and the deal price upon closing. I'll give you just a quick example of what happened in Pennsylvania years and years ago. There was a company that wanted to take over a local company. It was a huge S&P 500 company, but it was located in the center of Pennsylvania, and its price was $32 a share. This company was called AMP Incorporated, and another company made a bid for it, and they offered. I'm sorry, what did I say? 32? It was $28 a share. They offered $42 a share, which was 50% premium, which is about the average. And then there was some self-dealing. There was all sorts of shenanigans going on. There were multiple bidders. Anyway, so the first bid was $42 a share, but the actual merger of another company that came in and took it over, I think that's called a knight in shining armor. I think the closing deal price was $54. So this strategy of buying this target company at, what did I say, $42, and it went to 42, then it immediately went to 44 because AMP, they decided to issue a bond. They were going to repurchase the shares at $44, and so it went up to 44. But you could have still made $10. I mean, it's not arbitrage, right? It's not a guaranteed profit, but it's still sounds like arbitrage profitability there. So look at the very bottom teardrop point. If the acquisition is completed successfully, then the hedge fund, they earn this this premium, right? The $54 minus the 44 or the 42. Otherwise, the hedge fund may lose money. Now, the may lose money, the reason that we can extend this concept of arbitrage is because the target firm still has value, right? It's not going to fall to zero. And even if it falls, maybe it falls to 40. Well, you bought it 42 or 44 and it falls to 40. Well, a huge hedge fund can probably tolerate those kinds of losses. So that's really, really cool stuff here inside. And of course, you can do this with a tender offer. You can do it with a merger. You can do it with a spinoff. You can do it with a parent and a subsidiary. I mean, there are all different sorts of ways to accomplish this merger arbitrage. All right, how about investment characteristics? So these are all good questions. Notice we've bolded some here. So I'm encouraging you to go ahead, pause the video, and just write some bullet points down on your index cards. Yeah, cross-border mergers and acquisitions. It's enough to try to get a merger past the U.S. Department of Justice here, and then if you do it cross-border, then you have two different governments there. So that makes sense. Insurance works, in some kind of a manner here. Couple that with a put option, which is what I was saying just a moment ago. Relatively liquid strategy. There's limited partnership again. Leverage, moderate to high. Attractiveness. Ooh, this is probably important. Relatively high, sharp ratios, but look, left tail risk. Now, of course, we need to worry about our corporate finance background. Remember, we did this back in level 2, where we said something like, look, if I'm an acquiring firm and I want to take over a target firm, I have some choices. I could just pay cash. I can get out my wallet and say, here's $5 billion in cash. Let me have your shares. Or I can reach into my other pocket and say, here's some treasury stock that we have, or here's some authorized but unissued stock. Take this and you hand me over your stock. So this is important to know inside of this strategy implementation. Is the merger or acquisition financed with cash, or is it financed with shares of stock? Now let's switch over then to distressed securities. So let's go back to, what do we do, that Altman Z-score. So we find a company that is in financial distress or nearing bankruptcy. So what do? Well, we don't just take Altman's word for it. Let's go ahead and look at liquidity. Let's look at leverage. Let's look at downgrades, accounting irregularities, competitive pressure, inadequate cash flows. Boy, that's really gets to my heart. And it really brings about the whole Modigliani and Miller conversation about what's the most important driving factor behind the equity value of a publicly held corporation. And there it is. The ability of the firm to generate persistent cash flows. I mean, if you have a firm that has tons and tons of cash flows every year, it's probably not in financial distress. So that's the one that I would emphasize if I were creating a question, but that's just because of my fondness and love for what Modigliani and Miller taught us. All right, so here's the question then. Why would a company's shares of stock, now even though this is called, an equity-driven hedge fund strategy, we can't exclude the bonds issued by these companies as well. So why would stock prices have fallen so much? And then why would the bonds sell at such a steep discount? So this is the cool thing. Look, we can buy a bond that is trading at a steep discount. Let's say it's $600 on every $1,000 par value. We can buy a share of stock that used to be trading at $100 and is now trading at $20. And even if that stock goes up to $25 or $30, that's still a massive return on our investment, right? So look at that second bullet point there. Consequently, they are obliged to sell these securities at a discount. All right, that makes sense. Creates inefficiencies, opening up opportunities, and this is complexified by the simple fact that sometimes institutional investors out there are forced to sell these stocks and these bonds that fall in value. All right, so what can happen when a firm goes into bankruptcy? It can liquidate or it can reorganize. And so we're probably hoping for reorganization. So when the company emerges from bankruptcy, what did I say? Our share of stock, which we bought at 20, now sells for 60. Our bond, which we bought for 600, now sells for 700. That's really the goal of investing in these distressed securities, right? All right. Let's go ahead and pick out a couple of things here over these investment characteristics. Long bias, that makes sense. Broad range of skills. Returns, higher returns relative to other event-driven strategies. That's probably a really good question. Notice they're variable and cyclical, right? When banks start to crash, they tend to crash together, right? And so what you do is you find the banks that are crashing, and then you look at the banks that maybe the market overreacted to and that it looks like they're nearing bankruptcy, but the left-hand side of their balance sheet, they have tons and tons of super performing loans. And so let's go in and buy up their distressed shares of stock, and then, hey, those prices will then, of course, rise, right? So that's why higher returns relative to other event-driven strategies. Probably low leverage, not very liquid. The reading does say highly illiquid because, who in their right mind wants to buy a bond that sells for $300 or $600? Institutional investors, they're probably not going to do it because their mandates prevent them from doing it. But when my mother was alive, she loved her mortgage-backed securities. But there's no way my mother could have been convinced to buy a bond from, let's just pick a company, an Enron bond for $100 back in the year 2000. Suitability, they're limited partnerships again. All right, so if we have this liquidation, we need to have that recovery value. So what the analyst must do is take a look at the left-hand side of the balance sheet and say, what is the intrinsic value of those assets? And does that mean that they have a market value that is somewhat related to that intrinsic value? So the recovery rate is going to be a function of, think of it as the collateral for owning the share of stock or the bond, even though it's probably not considered that, especially with a share of stock. Look at that second block point. This is what I've been saying all along. There you go. Buy undervalued debt securities to realize a higher recovery rate. Now, in the case of reorganization, oh my gosh, we can have so many more positive things because the right-hand side of the balance sheet is going to be restructured. And that restructuring might enable us to participate in the future profitability. Remember, what did I say earlier? I'm not going to go back to that slide. We had cash flows on the bottom right. Remember, these are low cash flows. Maybe they were even negative cash flows. But if the firm can emerge from bankruptcy and then generate some kind of profitability, well, look at the bottom block point. Managers may exit and earn a profit. That should make perfect sense. Attractive during initial phase of the market cycle. We spend lots and lots of time on the business cycle, both back in level 2 and again in level 3. So there's probably higher returns. Boy, returns can be lumpy and cynical. Lumpy, by the way, is not a finance term. All right, what have we done? 2/3 here. So let's do relative value hedge fund strategies. What are we doing? We're comparing security A and security B. So look at that top diamond point, valuation differences between securities. Now, look, we did a little bit of this. We had a little bit of exposure with that pairs trading that we did before. That was comparing those two different shares of stock, but our focus then was on mean reversion and correlation coefficient and a long and short strategy, right? Pairs trading. Here, there's a unique difference. What we're going to do, well, look at the bottom. We've got those words again, arbitrage. So this is not pure arbitrage like in the traditional sense. But what we're going to do is we're going to look at liquidity, we're going to look at credit quality, and we're going to look at implied volatility as relative factors that might influence the prices of different securities. All right, so fixed income arbitrage. Well, look at the bottom there. What do we have? Corporate bonds, we can easily buy those. Government bonds, we can easily buy those. Bank loans, well, we'd have to go into the collateralized debt market, which we can do as a hedge fund, right? Consumer debt, well, we can go into mortgage-backed securities or credit card receivables, or which we can do as hedge funds. And so fixed income arbitrage, what are we doing? Well, we're doing something that we've done before. We want to take the long position in undervalued securities and the short position in overvalued securities. But of course, these are in fixed income securities. So once again, this is some kind of a model that's going to rely on reversion to the mean. Now, let's be careful and take a deep breath. Suppose we buy this mortgage-backed security. Remember, we've got things like negative convexity to worry about that we might not have to worry about if we invest just in corporate bonds or government bonds. All right, so high correlations. We know that in the fixed income market, yield spread pickup. So let me just go back here. Think about yield on the government bonds, whatever that thing is. Yield on a bank loan, that's probably way higher, so that spread is deep. Yield on student loans or mortgages, that's probably relatively high, so that yield spread is steep. So what can we do? Yield curve and carry trades, we did that back in level 2. There's a mention of mortgage-related markets and other sovereign markets. Leverage is high. I would put this down on my index card. Leverage is high, although it does decrease with the complexity of the project. And so here's an example. Think of collateralized debt obligations, or even some complex mortgage-backed security, or whatever it is. Remember what these institutions do, and I'm guessing some of you have done this yourself, is that you chop them into different slices, right? The French word for slice is tranche. And so some tranches have seniority, some tranches are junior, some tranches receive interest, some tranches receive principal, some tranches receive the return on the S&P 500. Remember we called that, kind of like an equity-linked tranche. You could divide these tranches up into anything. You could have a mortgage-backed security where the last tranche is the return on the new Indiana Jones movie. When is that coming out? The summer of 2023, which I'm certainly hopeful is way better than the last Indiana Jones movie. Although we can't compete with that third one, what with James Bond playing Indiana Jones' father. So you get my point, is that these mortgage-backed securities and these financially engineered products, they can be super complex, but when you chop them into their parts, they're completely simple. All right, so how are we going to do this? Yield curve trades. This is top down, right? We're going to start with an economic forecast, and then we're going to take a look at the yield curve, and we're going to find points on the yield curve that we might not like. Maybe we put some key rate duration in there. Maybe we do some kind of other things in there, but we're going to do a yield curve trade. Maybe we'll do some kind of take advantage of mean reversion. But remember, let me just go back here. How far? was this here? Yeah, that first circle point, right? Overvalued securities and undervalued securities. I mean, that's really what we're trying to do on that yield curve. And we can do something completely similar in a carry trade. But this one, by definition, is we take the long position in the high yield security and the short position in the low yield security. So that when interest rates fall, right? When interest rates fall, then that long position in the higher yielding security, hopefully that'll go up, right? So that should make perfect sense. Some problems there: liquidity risks, interest rate and credit risk. Yeah, those make perfect sense. Now, convertible bond arbitrage, what we're doing is we're just separating the convertible bond into its two components. The regular bond, we call that the option-free component. A lot of people call it a straight bond. That's what the reading uses. Plus a call option, right? You have the right but not the obligation to convert your bond into shares of stock. So we did this, I think, back in level 1. There's a conversion ratio, there's a conversion price, there's a conversion value. And so think about it like this. Suppose you have a bond that sells at par value for 100. And you have a share of stock that's selling for $20 a share, right? So what are you going to do? Are you going to convert your bond into one share of stock? You wouldn't convert $100 into $20. But if that stock price goes up, if that stock price goes up to 120, well, then maybe you'll convert your bond, which is worth 100, into a share of stock, which is worth 120. Now, look down at the bottom embedded bullet point. We can do our delta hedging, which we get from the Black-Scholes-Merton option pricing model, and we can trade according to the gamma. Remember the sensitivity of that delta to changes? Oh my gosh. So everything that we talk about in option pricing applies here. All right, investment characteristics. Yeah, there are not a ton of convertible bonds out there, so they're thinly traded, so we probably have to worry about liquidity. The historically cheap nature of convertible bonds. This trade tends to be in the long position. That should make perfect sense there. We have interest rate risk, we have default risk or credit risk, and we have market risk. Now, what we can do is we can hedge that or we can accept it. All right, so how are we going to do this? What is that return profile? It's a combination of fixed income and equity-like returns, so the returns are less volatile. Standard deviation is less volatile than shares of stock, but more volatile than traditional bonds. How can we find these things? Well, there are lots of different ways that we can find them, right? But what we can do is we can use put options, credit default swaps, and some kind of an interest rate futures contract or an interest rate swap contract. Once we identify, now remember, let me go back here real quickly. We're not going to just take a look at any old convertible bond. We want to find a convertible bond that has an option that is likely to be in the money, right? And that must mean that this company has uncovered but has not announced tons of positive net present value projects. So that's all part of our responsibility as the analyst. Less liquid, of course, that makes sense. Leverage, high leverage here in this market, rolls in the portfolio. Suitable during periods of moderate volatility, adequate market liquidity. It's going to fail if there's a mismatch, and that bottom orange point is probably the important one there. Strategy implementation. What are we going to do? Take the long position in the bond and hedge it by shorting the stock. Wow, that is the nature of this arbitrage, convertible bond arbitrage. So we're taking our opposite positions, but remember, these are not two perfectly opposite positions, so we might lose. I mean, that's the important thing. Yeah, look at that second arrow box. That second purple box there. Yeah, as the stock price and interest rates change, that means the bond price is going to change. They're probably going to readjust that hedge ratio, and that's going to be using the delta and the gamma that we talked about before. Now, how can we end this trade? Yeah, called. If the convertible bond is called, a lot of convertible bonds have a call feature. convertible bond matures, that makes sense. Or if there's a conversion or under default or the company is taken over, those make perfect sense here. So let's take a look at a quick example here. Investment bank in Australia, significant exposure to hedge funds, increase exposure to relative value strategies, engaging in convertible bond arbitrage, describe potential risks if there's extreme market volatility and short selling. And so there's some answers that we just discussed in that previous slide. So as we conclude this part one, you're going to have these. Well, you only have 3 index cards, right? So hopefully you've paused the video multiple times and you've written some bullet points down on those index cards. What I want you to do now is take a look at those index cards, go to the end of this reading, and just scan those questions there. I don't really want you to spend a whole lot of time just yet. We'll do that after we complete part 2. But I want you to scan it just quickly so you get a sense of looking at the index card, reading the question stem, and then looking at the answer choices, and you'll say something like, hopefully this will convince you, hey, you know what, Jim, that was a really good idea to craft these index cards. And then you might even say, hey, I can't wait to watch part 2 so I can do 3 more index cards. Of course, the most industrious of you will go ahead and look at the reading, and you'll have those index cards prepared before you look at part 2. So anyway, hey, thanks for watching. I had super fun. I'll have great fun when we get to part 2. Good luck studying.